Good morning, folks. We're just getting started here. Hope everyone's had a good start to their week. And just give me one moment. I'm just getting everything going here. All right. Let's talk markets and what's going on out there. So, welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. We do this every Tuesday at 9 a.m. So, set it on your calendar if you want to follow along with my work. We talk about a lot. Of course, we talk about order flow, but we also talk about the big picture going into today. One of the things that can't really escape my focus is the fact that there is a growing chance we may have a government shutdown this evening. And so, what I mean is, the US government's fiscal year starts on October 1st. So, technically, that's midnight tonight. The Congress has until then to figure out the budget for their 2026, or I'm sorry, the debt ceiling extension for their budget. And we're not really making progress. There's a growing chance that, in fact, there may be a shutdown that leads to some large layoffs across several parts of the government as well. So it could be a little bit disruptive. The reason I mention it is it could be a vol catalyst. It could be something that adds some risk to equities, to fixed income, and even to currency. It may also add some risk to some of the commodities, and it could be bullish for gold and silver. So we're going to be watching for that government shutdown, the headlines that are coming out. We also have jobs coming up in the form of JOLTS jobs openings at 10 a.m. and Conference Board Consumer Confidence at 10 a.m. as well. So it is kind of a jam-packed schedule. We also have Chicago PMI at a quarter of 10. That's not quite as big of an event, but it's still worth watching. Then Trump is going to make an announcement at 11 a.m. What that means and portends to is yet to be realized by anyone outside of his inner circle. More executive orders to be signed at 3 p.m. And of course, central bankers talking all day long, both in Europe and the United States. So let's quickly talk about risk. I always like to talk about risk on this slide. The general disclosures on screen. Really, the key point here, if you want to stay in business as a trader or an investor, is to not risk more than you're willing to lose, to always make sure that your portfolio is well capitalized so you can keep trading, so you can keep investing. Another thing that I personally do that I think is a really helpful strategy to consider is having separate accounts. So I have a separate short-term trading account, a separate swing trading account, and a separate investing account. And then I also have my non-taxable retirement accounts. And when I have my short-term and swing accounts get above a certain threshold, I roll the profits into investments, period. No questions asked. Most of those investments are things that I'm going to buy in that long-term investment account. Sometimes those investments may be into things like businesses or real estate or otherwise. The reason I mention that is I think it's really, really, really important that folks that are trading especially if you're doing well, that you have multiple diversified ways to make sure that if, say, you're not on a hot streak or something doesn't go as well as you'd hoped in your trading account to generate income, that you have other areas where that income can be generated or where capital gains can be generated or some combination of the two. And so that's why I like to mention that. I think it's a really important part of just overall trading discipline. Because at the end of the day, I know there's a lot of folks that say, hey, you can get into this, you'll be a millionaire, you won't have to work again, it's going to happen really quickly. They set unrealistic expectations that get people in trouble. I want to push to the other side of that. I want to set reasonable expectations that I'm hoping can set your mind to a more productive path. That is to say, you know what the destination is. We want to become financially independent and not have to worry about some of you know, the pressures of life. On the other side of that, however, there's a journey to be had here, and it's an enjoyable one. It's one of building knowledge, it's one of accumulating skills, and it's one of stacking that wealth over time. If you're lucky enough to make a big bet and it pays off really big, make sure you manage that appropriately in your mind. Because what I see a lot of traders do when they get that big bet and it pays off big is they start taking bigger and bigger risks thinking they have the Midas touch, and then they blow up their account. So I just mentioned that because I don't want you to be one of those people. And I hope the folks that are tuned in are doing well. And in this environment, it's pretty darn easy to do well. This is a really, really kind of forgiving bull market. Every time you have a dip, there's someone buying it. And most of these leadership stocks, they're just up, up, and away. Sometimes they pause for a bit, consolidate before their next move. But this is not how markets always operate. A lot of bull markets have corrections. Then there's always bear markets you have to worry about if we get into a more challenging environment. I'm not saying that's around the corner, but what I am saying is manage your risk carefully, because there's a lot of complacency in this market. The other day I was hearing about retirees, people in their 70s and 80s, max long growth stocks with no fixed income, with no cushion. And I'm just thinking, geez, they don't have any time to recover if there's an event and they had to cash out because there were pressures in their life. Most of the people that are tuned in here, I believe, would have time. So you can take a little bit of a higher threshold of risk. Just manage it carefully. So a bit about me. Been doing this for 20 years, trading, and just about 20 for investing as well. I started off self-funding because I was fortunate enough to have good mentors and enough extra income that I could fund a trading account. And I got involved with this stuff in 2005, mostly starting with stocks, then getting into options, then finally starting to get into commodities. I really love trading gold. As early as 2006, gold was one of my favorite things to trade. And it's funny because now we're back in an environment where gold is really fun to trade. There was a long period of time where gold was not that fun to trade, like basically a decade from 2013 to 2023. It wasn't quite as fun of a trading vehicle, but we're back in that period where I think, even though gold had about a 2% pullback overnight from its highs to where we are, I still think gold's on the way to 2000. I'm seeing silver heading up to $48 an ounce. We've been talking about these things for almost a year now on here, I want to say. And I think there's still room. Actually, it's been more than a year now that I think about it. And I still think there's room higher. The reason is that these are instruments that are, in effect, especially gold, hedges against uncertainty. And we have plenty of that uncertainty. Gold also benefits from periods of debasement of the underlying currency it's priced in, which is primarily dollars. There's so much creation of new money. Gold's got a strong bid in that environment. And it's likely to persist. So I'm still bullish of gold. I think pullbacks are something that are worth looking at seriously for considering adding positions in gold itself in some of the better run miners, similar with silver and some of its better run miners. The royalty streamers are also extraordinarily attractive in this environment because they have minimal risk. So this is a place where a lot of the folks that have been investing in that space are finally being rewarded with some outsized gains. But I also think it's early innings in terms of where this goes over the long run. That is to say, as long as the government continues to run aggressive deficit spending and is, as in essence, by doing that, debasing the dollar and also adding to economic uncertainty because more and more relies on that government spend, that's bullish for gold. In fact, I'll go so far as to say I think a government shutdown would be bullish for gold and silver as well, because it's going to add to that uncertainty. And it's only going to have a very small effect of limiting spend overall during that period. So let's talk about the pivots that we have for this week. Right now, we're looking at 66.98 on the S&P 500 and 24,752 on the NASDAQ. These pivots this week are derived from some of the options exposure we had going into this week. And so I believe these could be levels that are worth watching closely to be bullish above and bearish below. And so I'm looking at that on a swing time frame, but it's similar intraday. If you see that we get down to one of these levels, we build acceptance below it, and we continue to trend, that's definitely going to get me wanting to fade. Right now, where we are, we're kind of testing. We're sort of consolidating, getting, in my opinion, I think we could have some room to test these lower bounds today during the trading day. I think jolts might cause a little bit of concern because we're likely to see job openings falling again. So I'm just going to post these on my Twitter feed. And I also just wanted to quickly take a look at the NASDAQ swing pivots chart. Similarly, the NASDAQ is balancing above a key pivot here. This would be just a little bit lower than the weekly pivot, but it's a similarly important pivot at 24,660.75. You can see it's been major support during two of those drawdown days. We need to stay above this level to have continuation. So we've got two key levels to watch in the NASDAQ, 24,752 and 24,660.75. That 660.75, if we close the week below it, I think the NASDAQ is going to have more of a corrective impulse to come. And we have some exclusive deals for you all that are tuned in. If you'd like to get up to 40% off of Bookmap, you could bookmark this for later if you want. Visit Traderade.com/bookmap, scroll down to the special offers. You can check out some of the deals that you can get there on your first billing period. And also, this is the last day of this competition. If you'd like to win prizes from Bookmap, including access to the platform and having your pet featured on their calendar, this is a pretty cool and cute contest. You could do so. Just use the hashtag BookmapPets on X or Instagram. And with all that being said, we're going to start diving into the namesake of what we're talking about here, that being Bookmap. And on screen here, I just wanted to take a quick look at what happened overnight in gold. This was a pretty nasty drawdown. And what really stands out to me here is just the unrelenting nature of the selling. So this is just a straight up decline without really any buying coming in until about 5 a.m. You had that lower high put in, and then we started consolidating from there. So this was a pretty steep sell for gold to happen in such a short period of time. And let's just get to questions here. So a few questions. Do I think aggregate Vanna is the most important tool to watch Vanna flow? We prefer using the SPX options visualizer, and we're focused on volume, and we're focused on some of the key levels of exposure. And so if I shift over to my feed for the S&P 500, you can see the SPX options visualizer levels. Now, this is a tool that I built. The data is pulled in from the CBOE and analyzed on a minutely basis during regular trading hours. And it puts up levels for where the most active strikes are for calls and puts. It'll paint a midpoint if there's some balance between there. Usually you get some midpoint reversion. You can see confluence with that midpoint and the point of control, giving it some more validity here. And then it also points out where the gamma flip level is and where some of these key levels are, like call walls, put walls, key levels of exposure. So this is a tool that we find pretty handy because often is the case, it helps us identify areas of resistance and support, and on trend days where the flow agrees with the trend, where we may get to based on that trend extension. So those are the areas we really focus on. We find it to be quite helpful when there's one side that has an edge. Often it's the call buyers that have an edge, and often it's the hot call that we ping to a T as the high of the day when that's the case. So it's a really handy way of visualizing that data. And I have a question. What's my name on the Bookmap Discord? My name on the Bookmap Discord is Markets and Mayhem. And I'm streaming live on there right now in the Futures Mayhem channel. You're welcome to come hang out if you're on there. And I've been asked, do I use Spot Gamma and Hero tools, etc.? I do not. I use the SPX Options Visualizer, and I'm building those same tools for NASDAQ, for Triple Q, for SPY, and for the major Mag 7 stocks. In fact, they're all ready to roll out. I've just had a bunch of other stuff I've had to do first, but getting ready to roll those out to the general public. They're available on the Discord right now on our streams when we do our educational streaming. And then a couple of other questions. Can you show us the volume profile in Bookmap? Sure, that's the session volume profile right here. And you can see green showing that there is an excess of buyers. So this is a delta volume footprint. Red showing an excess of sellers. So for example, right now you've got a bunch of buyers above current price. You could infer, if you're assuming they're buying to open contracts, that they're a bit outside of their buy-in price. That is to say, they're losing money right now. So if price continue to drift lower, they may start to become more motivated sellers. You may even start to see some stop runs. And as we get into the trading day, we will talk about stops and icebergs as they're coming through. But you can see on the subchart an aggregate of icebergs, an aggregate of stops, and then similarly with these horizontal bars, you have that information presented on screen, and then indicators on the main chart when they stand out. That is to say, when they're large enough to matter. And I have things set up specifically to illustrate those periods in time. So if you go into your settings on Bookmap, and we're just going to go into the add-on section here. And then if you look at your on-chart settings for icebergs, you could set up something similar to what I have, which is 90-minute interval, 10 standard deviation, and then color coding your icebergs and just showing execution icons, active icons, cancellation, aggregate ENC, and total volume. That is similar to what I do with the stops as well. With the stops, I'm showing a 90-minute time interval with a 10 standard deviation multiplier, red sells, green buys, and I'm only showing stop runs. So with icebergs and stops, what you're really looking at is order flow from the MBO data package. This is order flow that's crossing CME that is identified as a market stop or an iceberg, which is a passive buy or sell order. An iceberg, which is often misinterpreted, is it's very simply an order where you're not showing your full size. So say you needed to move 10,000 contracts of S&P and you decided to break that up into lots of 500, you'd have to move 20 of those lots. But in doing so, you're much less likely to scare the order book away from your price than if you just flash 10,000 and everyone runs away because they're like, what does that guy know? And as we see those icebergs and stops, assuming we get some of that activity during the trading session, I'll point out the indicators and what I read from them. And $Gen X saying, I have 3 accounts, small cap for intraday or small cap intraday, long investments in crypto, but nowhere near the size that is anything significant. But yeah, you know what though? You got to start somewhere. And so I like where your head's at on that. You got to start somewhere. That's really the key to all of this. And if you're starting with those best practices early in your journey of trading and investing, you're already on the right page. So just think about that. an account for day trading if you're so inclined, an account for swing trading, again, if you're so inclined, an account for investing. Possibly multiple accounts for investing. If you're like me, you're going to have a taxable account. You're going to have probably several retirement accounts depending on your strategy. Like I have a Roth, I have a SEP. So these are things to kind of incorporate into your strategy because it allows you to keep your risk levels lower if you're not putting all of your money in one account and churning it in short-term trading. You're going to do a lot better over the long run if you set a threshold and move that money into long-term investments, whether it's in stocks, fixed income, real estate, businesses, or otherwise. And folks, if you have any questions while you're tuned in, you're always welcome to put them in the chat. And I will get to them as soon as I can. I'm monitoring about 5 chats right now, so sometimes there'll be just a little bit of a delay. And just looking around at futures this morning in general, let's take a look at the S&P overnight. Pretty boring. Just a bit of consolidation during Globex. Yesterday's session was somewhat uneventful as well. We're going to be looking at that 20-minute opening range and the distribution of options interest to get a sense as to what kind of volatility we may experience during today's session after the market opens. So we'll just tune this back to a 20-minute time interval. Really, the spicy price action was in crude oil and gold overnight. Crude really continuing to slip here. OPEC talking about further expanding their production. Now, whether that ends up being an actual thing or not, that will be determined. There's some conjecture that they don't have the slack to further expand supply. But on the other side of it, if you infer that part of their goal is to weaken U.S. producers, they are accomplishing that goal. Because with oil prices as low as they are, there's a lot of producers that are having to start laying people off and shrinking some of their footprint. We already got a headline out of ExxonMobil this morning. They're firing 2,000 workers as oil sector job losses mount. And this is part of a broader set of headlines where I've heard of other producers similarly beginning to lay people off, idle some of their rigs, or just shut them down. And the real rule of thumb is, at least for a lot of the U.S. producers, you need oil at 65 or above for them to be doing okay. So now that it's holding below there, and it's likely, in my opinion, to roll over further, I think the oil chart on a weekly really looks just like a long-term downtrend with new lows being threatened and very close, in fact. In my opinion, it's likely we get to West Texas Intermediate crude, which is the benchmark we often look at, in the high 50s in not too long. So as we get into the trading day here, let's take a look at a couple charts in the futures market. First, let's look at that oil chart. And you can see that drift. Look at this weekly chart in oil. This was the Russia-Ukraine invasion spike here. Ever since then, it's never been able to reclaim those highs. In fact, it's just been really, for the most part, lower highs and lower lows, with a few exceptions along the way. You had a higher high here, you had kind of a similar high here, but overall, it's just been rolling over and consistently making these new lows. It feels to me, with demand starting to drop off and supply threatening to expand, that we could see oil make meaningfully lower lows before the year is out. So that's something to keep an eye on. If you're in the energy space investing, I think caution is warranted. There will be some trades that come out of this, probably some reflexive bounces off of lows in some of these companies and in the futures itself. But for now, I think we have to see that new low play out and see how we react. Let's take a look at gold and silver as well. Gold's been relentless. I mean, you can't even really see that blip from overnight, even when we put it on a daily. But one thing you'll notice with gold, it really likes the 50-day moving average. So that would be the area where I'd start to get a little more cautious. If you make a dip below the 50, you can see things get a little more shaky. But for this whole year, we've barely been able to look below it. And I think that tells us, in no uncertain terms, that that is a really important level to watch in gold, that 50-day moving average. Silver is another one. We've been talking about gold and silver, looking for $4,000 gold, looking for $48 silver. We're almost at the finish line with both of those. And I don't think that that's going to be the end of those trades, but I think it's more likely they consolidate. When gold hits that big psychologically important number, I would expect some profit taking to happen, just like when silver gets back to its non-inflation adjusted all-time high from 2011. I think it's likely you get a little bit of selling in there. But overall, I still think that the trend and the reason behind the trend, the big macro overlay as to why this is all happening, remains valid. So we're going to pull that back. And we are just about 5 minutes away from the market open. And just a friendly reminder, we've got Chicago PMI coming up at 9:45 a.m., U.S. JOLTS job openings at 10 a.m., and U.S. Conference Board consumer confidence at 10 a.m. as well. So those are our volatility catalysts that are on the calendar that we're aware of. Now let's talk a little bit more about those, because they might be the most interesting part of our trading day. We'll see. But for JOLTS, we're coming in with a forecast of 7.2 million, which is higher than the prior reading of 7.181 million. I'm inclined to think we come in below forecast, but it's really going to depend just how much below forecast we come in as to how the market reacts. Obviously, you have to play this two sides. You have to be ready for the big above forecast number that could come out. Let's say that could be 7.6 million or above, and the big below forecast number that could come out, which could be, say, 6.8 million or below. Those would be the two catalysts that could bring some excitement to the market. If it comes in within expectations, it's not really going to be that exciting, in my opinion. But if we get a big beat in jobs, I think that actually might be seen as constructive. I think we're going to get back to an environment where good news is good news, because the market's getting a little shakier about where the economy could go from here if this job market continues to deteriorate. Of course, it does want further rate cuts, but I feel like what's going to be more important in the near term is the labor market not showing faster signs of decline than what is already anticipated. So if we get a big hotter number from JOLTS, let's say 7.7 million or above, I think that would be reacted to positively. I think the long end could go up, rates could push higher, but I think stocks could rally into that, especially some of the more cyclical components. For consumer confidence, this is similar. It's not quite as market reactive as JOLTS, but 96 is the forecast. The prior reading was 97.4. A forecast of 92 or below would probably cause stocks to start to pull back and rates start to drop. And a number above 100 would probably give us a good amount of interest in buying back into a lot of these names, especially the higher beta names. So the two numbers we're going to look at really closely are going to be JOLTS and consumer confidence. And I'll stay on for a couple minutes to talk about what we're seeing in the market reaction there as well. And folks, if you're enjoying the stream, feel free to give it a like, share it out there with your friends and colleagues. We're just about 2 minutes away from the market open, so let the fun begin. We'll have market on open and balance data in about a minute as well, which I'll share with y'all. And we do want to pay some attention to this level yesterday's support area of the hot put and vol trigger. This was a pretty big deal during trading yesterday. We pretty much every time we got to it or below it, we saw a lot of interest in buying. And I would be inclined to think that continues into today, but we're going to have to see what the data brings us. And I'll show a different view in just a moment of the S&P. So here is the S&P 500 viewed a different way. We do have a buy-side market open imbalance today. I don't typically see this data as super meaningful, but it's still interesting to watch. And what I wanted to say is this is an area that was really big support during yesterday's regular hours trading. So this confluence area between the pivot around 6,700 and the hot put vol trig level. This is an area that had been powerful support. You can see overnight we consolidated a bit below it, but as soon as we got closer to open, we've started to see interest build above it. We're back above the big green line. This is a very simple momentum moving average you can put onto your charts as well. It's simply an EMA 21 on a 5-minute period. And two of our mods at Traderade wrote an awesome white paper about how much this simple moving average, or exponential moving average as it turns out, can be a great guide for momentum intraday. And markets are open here, getting just a little bit of volatility off the open. We're seeing the point of control drag just a bit lower by some of that selling pressure. And I'm being asked if the gamma levels that we're showing here are on the chart. They are, in the sense that on Bookmap, they are in this column when the add-on is being used and the data feed is active. They are in the SPX options visualizer column. And then on MotiveWave, they made it really easy to just paint the levels on the chart. So I've done that on MotiveWave. This add-on is available for both MotiveWave and Bookmap. And how do I use the gamma levels? It depends on the level, but gamma levels themselves, the ones that are labeled gamma levels, tend to be a bit more magnetic, and the key levels tend to be more like support and resistance. And I've got a whole document I wrote up about this. You're welcome to check it out if you want to visit traderade.com/SPX. That's all about the SPX options visualizer. We've got videos and documentation about how it works and how we read these levels. And then if one subscribes to it, it comes with a whole manual with more information about that as well. And seeing just a little bit more selling pressure here. Remember, we're watching this level, the hot put vol trig level from yesterday for now, as that was a pretty key level of support, and it has some confluence with a dynamic pivot that we have down there as well. So just a quick reminder, there's that dynamic pivot. Here's the vol trig showing all of that on this MotiveWave chart, just to paint that confluence area for us to remember later, perhaps sooner than later, given that this is still seeing some selling pressure. You saw a little bit of a buy stop run down here, which is strange, but it happened. This is 56 stops on the buy side on that tiny little drift up. And we are making new session lows. You can see that this green line on the bottom is the lowest price level. The red line on the top is the highest price level. I set that up to easily be able to map out the opening range, but also it's just helpful to know, especially if you're in a trend day, if you're making new highs and new lows. And we are making more new lows here, cutting below that vol trig level, getting quite close to the pivot. And this is a juicy amount of sell side delta volume here. You can see that's the highest amount. I mean, it makes sense with the market open, but it's the highest amount that we've seen over at least the last 5.5 hours. So there are some motivated sellers in this market open, offsetting the modest buy side market open imbalance, which again kind of gives you a sense as to why I don't pay a lot of attention to those numbers, because they don't typically give you any sort of trading edge. Let's check on how our shiny friend gold is doing. And we're just going to pull this out to a 20-minute time frame. And I'm going to actually add something to this chart here. Just those best bid and ask, because it's a little bit sparse, the amount of trading volume coming through. But overall, gold showing just a little bit of spiciness this morning with its volatility from the open. You've got about a 7-point range so far. Let's see where it is after about 20 minutes. But buyers are showing a little bit of interest off the open in gold, a little more aggressive buying in these larger delta bubbles. Let's check on silver. Somewhat similar looking silver, and I'm also going to do the same thing with this silver chart. But you are seeing some interest in buying silver off the open. It's all but inevitable that we hit $48 probably in the next week or two. Shift over to the NASDAQ. NASDAQ really seeing some motivated selling off the open. And we'll just quickly pop a heat map here to show you guys what we're seeing. So some weakness here in Microsoft, Google, Meta, Amazon, Tesla, Intel, some of the NASDAQ heavyweights slipping. And that's adding to some of that downside that we're seeing in the tech-laden index. And this is the NDX options visualizer showing the same sorts of options-derived data. It's extrapolated from the NDX options chain and then converted, factoring for the delta into NQ levels. I would expect that we could get some support around key 1 plus and this vol trigger level. So there is some potential support down here. We're seeing some stop runs in the NASDAQ as well. Before 48 contracts stopped out, now 93. Considering the NASDAQ order book depth is about 7,000, those are somewhat meaningful stops. You also have a passive seller overhead that was leaning into that little pop above the point of control. So this is looking kind of nasty for the NASDAQ. S&P doesn't look great either, but the NASDAQ just has a bit of a weaker look about it, given the components that are big parts of it slipping today. Again, that's Google, Meta, Amazon, Tesla, and Microsoft looking the worst. Intel not having a great day, although it's a smaller component. And we're just about 22 minutes away from the big data prints, 7 minutes away from Chicago PMI. And we have slipped below that pivot, suggesting between slipping below that and our vol trig level that we could see some further downside here. We're just retesting that pivot level, but we've been pushing below it. So I would like to see us get back to these pre-market lows and slip to suggest we've got more room. But overall, this is starting to look kind of weak. Also slip below the BGL. You can see that here, that red dot painted on chart to show that that candle closed below the big green line, or the 21 EMA on a 5-minute chart. And just a very kind of stair-step pattern down of selling. Lower highs, lower lows, microstructure downtrend. In the S&P and in the NASDAQ, it's even more pronounced. NASDAQ continuing to make some new lows here. And these levels will be updated shortly once we get enough flow in to have the algorithm crunch that data. The levels for the NASDAQ, the S&P, SPY, Triple Q will all be updated, as well as IWM. Can see NASDAQ starting to push away from this resting bid below. It's usually a good sign, just suggesting that at least for the moment, the sellers don't have much supply to push lower. On the other side of it, though, buyers not showing too much conviction on this pop. They had an opportunity to run this thing, and they're still not taking advantage, at least yet. Let's take a look at the S&P. They pushed a little harder on the S&P. You could see a little bit more conviction, and that did cause 90 contracts to be stopped out, presumably from some of these shorts. The market's trying to base here, and also getting ready to digest these 3 data points that are about to come out. PMI coming up in just about 2 minutes. U.S. Chicago PMI, the forecast 43.3, the prior reading 41.5. Let's take a quick look at our high beta beast friend, Bitcoin. Bitcoin so far having a nice run off of its AM lows. We can see the point of control quite a bit higher from here. It also slipped. Really, crypto has had a rough run over the last couple weeks here, but it looks like it's trying to base. I'm still looking for a new low on crypto as well before we really resume the rally, but obviously anything is possible. That would just be the best risk to reward setup for how I like to trade momentum in these things. So if it doesn't happen, I'm not gonna force the trade, but that's what I would be looking for. Really a retest of the. Let me go back and look at what I have on my screen. Yeah, I'd like to see Bitcoin retesting the 50-week moving average. I'm going to show you why real quick. So here's a nice little Bitcoin chart, and you could see on screen when it hits the 50-week, it really is a great way to nibble. You get these panicky kind of trades, you get these spikes down, and they're often bid into aggressively. So for me, for managing risk to reward, I'd love to buy that because I can keep a kind of tight stop below it. And I'd be interested in accumulating if it tests that level and holds. That to me would be the ideal entry in something like this. And we're seeing a pretty big pop off those lows in the S&P, some more aggression. You can see that these delta bubbles are showing the difference between buyers and sellers. So you're seeing some more buy-side aggression coming into the S&P ahead of Chicago PMI, which is set to drop in about 10 seconds here. You can also see we're basing around that volatility trigger level and pivot. So we tested below the pivot, and like yesterday, there was an appetite to buy. And we got that Chicago PMI data. It's just dropped at 40.6, lower than the forecast of 43.3 and the prior reading of 41.5. This is not a major event volatility catalyst, so I don't expect it to have too much of an impact on price discovery, but at least we have that out of the way. Now looking ahead, we've got JOLTS and USCB consumer confidence coming up at the top of the hour. And S&P futures now pushing towards session highs here. So we had a bit of a head fake, even faked me out a little bit earlier on that big amount of volume and the selling and that test below the pivot. But guess what? Just like yesterday, that look below the pivot ended up with a reversal. So there's still an appetite below the vol trig and the 6700.75 pivot for buyers to step in. Let's see if that lasts through the next data point we're going to get, JOLTS and CB consumer confidence. That's the real test. We also we're pretty close to our 20-minute opening range on ES. And so far, we've got about an 11 handle opening range. It's nothing spectacular, but it's certainly not as bad as we've seen on some of the prior days. Nevertheless, I'd like to see that range expand to at least 15 to suggest we've got some potential for a more interesting and dynamic trading environment today. Similarly, we're starting to see some of the flow come through. It should be mapped out any moment now from the CBOE SPX options. I'm just going to tune in to some of the flow we have on the Traderade Discord, where this stuff is updated every 2 minutes, to look for that coming in as well. And we did see a small new high for the S&P in that last move, so that's good to see. Nice reversal. Again, like we were talking about prior to the market open, that level below the vol trig and that dynamic pivot area, that confluence between those two levels, was once again an area of important support. And we're starting to see some of that flow come through. There is more interest in puts at the moment. The most active put strike is getting a little bit more attention this morning. It's around 6,600. But we'll see how that balances out. It's a little early yet. You can see that down here, that most active put strike coming on screen. But typically the very initial flows come in a little bit. That is to say, the range of strikes tends to narrow a bit as the morning goes on. So we're watching for that as well to give a better sense as to what the expectations of some of the larger trading desks have for the range of price discovery today. Also important to note that quarterly OPEX is underway, and you do have some larger positions being rolled as a result of that as well. Almost feels like every day is OPEX, and I guess you could say every day is OPEX in the indexes because you have all that zero DTE volume. It's about 60% of total volume for SPX. It's amazing that an instrument that trades 1.3 trillion of notional every day has about 60% of its volume expiring the same day and about 80% within a week. We've become a very, very near-term focused market. And just a very choppy start to the day. Look at these 5-minute candles. It's kind of barcoding. We're slipping back below the BGL. We're getting bit of a bid coming in from that. Never mind. But again, watching that vol trig and pivot confluence area for support once again, especially as we're just about 10 minutes away from JOLTS and CB consumer confidence data. This is really my intraday pivot area. If we slip below this and build acceptance, like that is to say we've got like a 5-minute candle or two below that pivot, that's going to give me a sense that we've got some room lower. We start taking out those pre-market lows, that gives you even more confirmation of the same. Fed's Collins also saying we're not out of the woods on inflation yet. We are seeing a bearish fair value gap here as well. This candle opening below the prior. That just suggests you could have some downside continuation. You could see the bullish fair value gaps help to give us a sense that we're going to see some upside continuation. And once again, starting to base around this vol trigger level. You could see sellers kind of lost their appetite to sell. We've also seen the point of control drag down here, giving us a sense that that further validates the importance of this area. Now you sort of have a trifecta of confluence. The vol trigger, the pivot, and the point of control, all right around here, making this level even more important to watch to determine directionality. And we do have our 20-minute opening range, and it's not too inspiring. Just about 11 handles on the S&P 500 futures. So that suggests you may not have the most dynamic trading environment today. And people watching this are probably like, yeah, so what else is new? You're right. This has pretty much been the status quo. Volatility compression. You all are also seeing the puts are significantly in excess of demand of the calls. Some of this may be event volatility hedging ahead of JOLTS and ahead of some of the other things that are happening, but that is giving you a sense that there is some heaviness to this tape. And you have an iceberg seller coming in on the S&P futures here as well. 335 contracts passively sold. And put flow continuing to build below here. Also starting to see some offers stack above. It's really going to be important to see how we react to those offers. Initially, this offer was rejected, but it looks like buyers are going to give it another go. If you look at the market pricing process as an auction, it's really important if you see offers above that buyers are able to push through them to show they have enough demand to do so. Seeing some exhaustive selling in the NASDAQ here. Here's our exhaustion indicator coming on screen. I'm just going to grab a snippet of that to share. You can see we're basing off that exhaustion print. Usually what you see from exhaustion is just a little bit of a pause. Sometimes you see a reflexive buy, other times it's just more consolidation. For me, if I was fading this move and I saw an exhaustion print like that, I would likely cover a part of that short into that. Wait for a potential reoffer opportunity. We may not get that with the way this thing is pricing, but it's something to take into consideration. Just about 5 minutes away from data, US JOLTS and CB consumer confidence. And as a reminder, for JOLTS, we have a forecast of 7.2 million, prior reading of 7.181 million. For CB consumer confidence, you have a forecast of 96 with a prior reading of 97.4. And what would juice the market's ability to be more dynamic would be outlier prints that are well outside of the forecasts. Seeing some flows to bid BABA coming through as well, just looking at the options flow. Looking at those 190 strikes for November 7th. About 141,000 chasing those calls. And you could see from that exhaustion print, we did get a bit of a base. Buyers started to get a little more aggressive and we're pushing off that. So I'm also going to just take a quick screen cap of that to illustrate on social how these prints can behave. And this is exactly why when you see an exhaustion print, if you are fading the instrument in question, if it's me, I tend to take a piece of that off and then look for another reoffer opportunity, which seems like that's what we're getting here. So just something to think about with these indicators. They can really help short-term traders not have to dig too deep into the flow to automate some of that analysis so we can preserve our mental capital to hopefully stack more real capital. I will say, however, on the other side of this, one thing that's worth noting ahead of the data releases is put flow is really picking up. It's about twice that of call flow, if not more. And the order book is lightening up as we're just about 2 minutes away from data. This is one reason to be very careful trading around these data releases because you're just not going to have the liquidity for good fills. So execution could have more slippage, meaning you don't get the kind of order or the pricing that you want. You may not get the size you want. You may not get the price you want. If a stop gets triggered, it may be way worse than you were expecting. So just be careful ahead of these data releases. You can see liquidity is becoming more constrained. And price is just picking up above our triple confluence area of the point of control, volatility trigger, and pivot, ahead of JOLTS and CB consumer confidence. Data coming out in just about 30 seconds here. Once again, that's JOLTS with a forecast of 7.2 million and CB consumer confidence with a forecast of 96. And I've been asked if I trade gold. I absolutely do. I've been trading gold for 19 years. And it's been a lot of fun to trade recently. Flows still put heavy ahead of the data. Data coming out now. JOLTS coming in at 7.227 million, right in line. So no outlier in JOLTS. So far, the market receiving that positively. We're still waiting on CB consumer confidence. Just come in 94.2 versus a forecast of 96. So JOLTS a bit better than expected. Consumer confidence a bit worse than expected. Overall, the market reacting positively to these data releases, pushing above our trifecta level, the volatility trigger, point of control, and pivot. Because these data releases were not worse than expected, another thing that we could see is some of those puts, some of which may have been hedges for these same releases, coming off, which is liquidity positive as the market now makes a new session high in the S&P. We'll want to watch these strikes ahead or overhead, I should say, the call and the hot call and the warm call. We do have a wall of calls just overhead around 67.55 to watch as well as potential resistance. But it does look like interest in buying is coming back. I do want to see us hold that trifecta level. That area needs to remain support, and buyers need to continue to have an appetite to take some risk above those levels. But if we can, I think we could continue to trend towards the most active call strikes. I'd also like to see the flow in those strikes improve markedly over the next hour and exceed that of the puts to give us a sense that we could kind of reverse and start to break out here. And folks, if you're interested in learning more about what I do, visit me on the web at www.traderade.com. If you'd like to get up to 40% off Bookmap, check out traderade.com/bookmap. That's traderade.com/bookmap. Scroll down to the special offers. And if you'd like to learn more about the SPX options visualizer or pick up your own copy for Bookmap or MotiveWave, visit traderade.com/SPX. That's traderade.com/SPX. I'm here every Tuesday at 9 a.m. Eastern. I want to thank you for tuning into this week's edition of Back to the Futures with me, Markets and Mayhem. I'll see you next Tuesday.